All right, so your exam is going to be on chapters 1 through 6. Okay, today we're only going to cover the first 4 chapters. Tomorrow we'll cover chapter 5 and 6 and go through all those problems. Okay, so here for chapters 1 through 4, okay? This is the review sheets. They're just the copies of the PowerPoints. And this is what I really want you to get away with when we are going through each chapter, right? What is the key idea and key thing that is the most important thing about this chapter? So obviously the first one is, well, what is accounting, right? That is definitely going to be your number one thing right there. And also knowing the nature of a business, right? Here gives you the 5 different business organizations and gives you pretty much a little summary of each one of what they are, what the differences are, okay? Now, it doesn't give me my pros and cons, but at least I can be able to tell the difference between these entities by saying, okay, sole proprietor means one person versus a partnership, there's 2 or more people, right? That's what I want you to do when I want you to identify as these different, what's the difference between these organizations, okay? So here are the 5 organizations and what the differences are, okay? I also need you to know what accounting is, know the difference between the bookkeeper and the accountant, as well as knows the business activities, right? Here, I don't give you definitions, right? But these ones are pretty straightforward, right? What's the definition of a service, right? You guys should know the difference because we as a consumer are looking into purchasing either a service or an item or even create the item, okay? That's the purpose of what we do as a consumer is we buy into these services, so it's straightforward, right? A service is where it is a time-based service, right? Where you're getting some kind of whether it's you're getting something taken care of, whether if it's accounting, you're getting professional help on your business, right? If it's a lawyer, you're seeking professional help on a case, right? That is what a service is. It's not an actual physical product that you can physically touch and take home, right? And that's the difference between a service versus a retailer or a merchandising, right? Where they actually sell a physical product to you. And of course, a manufacturer, right, we talked about, which is the person who creates those products to sell, okay? So knowing the different business activities, right? Again, I just give you what they are. You need to be able to define them and tell the difference what they are, okay? And again, you need to know the 4 financial statements as well as the 5 areas of accounting, okay? Now, key component that you really need to know is that for the sake of this entire class, right, we are focused on a sole proprietor or a small business, right? And this one means that we are going to be focusing on the private accounting, right? Where we're doing financial accounting, right? Where we're looking at a business from start to finish, and all our job is to record the basic business transactions to do bookkeeping, right? That is our main focus, main area of accounting is private accounting for small businesses such as a sole proprietor. Okay, so that's chapter 1. Chapter 2 is where we need to determine what the 5 types of accounts are, right? Assets, liabilities, equity, revenues, and expenses. We need to know how to use the accounting model, right? How do we know whether to debit or credit a certain specific account, right? You need to know, again, what accounting is. You need to know the difference between left and right. And you need to know the definition of what the normal balance is, as well as here are the categories of each asset type and knowing the difference between your permanent and your temporary accounts, right? This section is going to be very important because I will give you a specific account. I'll give you a description, and your job is to identify the account type, the category it belongs to, and what kind of normal balance it has, okay? And I'll formulate that question in a multiple choice question, okay? So again, I'll give you an example when we dive into our study guide here, but this is going to be very useful. So in case you're very, you get confused between the different categories, this is what's going to help you to make sure that you have your ideas straight, okay? And you also get a copy right here of the accounting model, all right? And the accounting equation is right here, okay? Next is going to be chapter 3, where we talked about the difference between what the chart of accounts is, the difference between the journal and the ledger. I'm not going to really test you on T accounts, but the most important thing is journalizing, right? How do you journalize, okay? Right? It must be formatted exactly like this. Now, again, I'm not going to test you on exactly how it should look, but I am going to test you on a couple questions where it may require you to journalize a transaction, and you need to do it correctly, right? Your debits and credits must equal, okay? You need to have a debit account and you need to have a credit account, right? And that's going to be depending on what the transaction is. And I'm also going to ask you a question to correct a journal entry, right? So you could be doing either or a error cancellation or a reverse and re-entry example, okay? And then chapter 4, you need to know the steps of the accounting cycle, okay? You don't need to know how to do these steps, but you need to know at least the order that it belongs into. Because what the most important thing about this class is, since we're in the very beginning stages, right, we're actually only going to be looking at the first 3 steps, okay? The rest of these steps is going to come into play when we dive into our class project at the end of the 5 weeks. So in this case, I don't need you to know how to do, but I definitely need you to know what they are and what is the order that they come into, okay? You also need to know the difference between what the accounting period is, okay? And, and what the accounting cycle does for the accounting period. And then, of course, you need to know what the 4 characteristics of financial statements are used for, okay? And, of course, you're also going to need to know your ABCs, which is your assumptions, your basic principles, and your constraints and your concerns, or constraints and conventions, okay? They're generally accepted accounting principles, GAAP, okay? GAAP for short. It's the United States GAAP. I don't need you to know who made it. I don't need you to know anything else in regards to international, because we are in the United States, so that means you're only focused on the United States GAAP, okay? What I want you to take away from this chapter here is I will not test you on your constraints and your conventions, okay? I will only test you on the first 8, which is your assumptions and your basic principles, okay? Because the constraints and the conventions, this is more for manufacturing businesses, right? Determining whether something is worthy enough to record, or having to weigh the cost versus the benefits. That is definitely going to be a decision for manufacturers, right? How much is it going to cost me to weigh out the benefits of me producing the product, right? So in this case, I will not test you on the last 4 generally accepted accounting principles here, okay? So no constraints on here, okay? I will test you on your assumptions and your basic principles. Now here, once again, I've only listed them out. You need to know what the definition is and how to apply it to the given scenario, okay? So I can ask you either or. I can ask you a definition question, or I can ask you a applied knowledge education, okay? Meaning I can give you an example. For instance, I have a business credit card versus a personal credit card. What is an example of that? That would be the business or economic entity, right? You need to separate your business transactions versus your personal transactions. That's the definition, right? And I gave you an example, okay? So that's what I mean by applied knowledge, okay? You need to be able to take these because they in the background, these are the core fundamentals of why we do everything that we do in accounting. So it's very, very important that you do know at least the first 8 principles, okay, and not so much of but the last 4. But even though the last 4 is something that you should recognize, it's not super important for financial accounting, okay? So again, I'm only going to test you on the first 8 sections here. And then last but not least, right, we talked about the cash versus the accrual basis, right? Cash is pretty straightforward, right? If you have cash, you're going to record it. If you don't have cash, well, then you don't record. Pretty straightforward, right? The idea is cash needs to be in your hand to record an income, and cash has to leave your hand for you to be able to record an expense, okay? Where it is opposite from accrual, right? Because accrual, it doesn't matter whether you received cash or not. The fact that you sold something, right? Whether you received cash or not, you still sold something. So that means you earned your revenue because you got rid of your inventory item. You sold it, okay? Regardless whether you received cash or not. Same idea with accounts payable, right? If you have an expense, right? And if the job has been completed and you have been billed, whether you paid for it or not, the idea, did the job get done? And if it has been done, which means incurred, then you would record that expense, okay? So that's the difference between the two, okay? One of them doesn't matter whether you get paid or not. If you sold something, you record it. If the job is done, you record it. While the other one is you need to have the cash in order for you to record the income, and you need to have the cash in order to record the expense, okay? And that is it for the very first 4 chapters of okay, of what we talked about, okay? Hello, Marcy. Okay, so again, okay. So let's go ahead and dive right into the study guide. All right. So again, first couple questions here are going to be, for example, chapter 1. Okay. So question 1 asks, what is accounting?
It's A.
The process of recording, sorting, and summarizing all business transactions and events. Good. Okay. It is not the process of creating formulas. It is not the process of elimination. And this one says it is the process of collecting data from all business transactions. In this case, that is correct. However, you do more than just collect the data, right? You have to analyze it. You have to sort it. You have to organize it. So in this case, A would be the most correct answer. Okay? Number 2, which of the following areas of accounting does financial, managerial, financial planning, and treasury accounting belong to?
Private accounting?
Private, because if you remember what I just mentioned about a minute ago, I said we are in the financial accounting, which is this class right here where we're looking at a business, right? We're looking at the very basics information about a business, which is for a smaller type of business. So in this case, this is definitely going to be in the private sector. Okay, private accounting. Good. Number 3, okay? Which of the following is not a business organization?
All of them are.
All of them are. All of the above, okay, are business organizations. So your correct answer here is D. Okay. Number 4, okay, which of the following financial statements is based on the accounting equation? Assets equals liabilities plus equity.
The balance sheet.
The balance sheet, right? Hence the formula, right? It has an equal sign on it, meaning you're going to have to try to wager them so that they're equal to each other. So in this case, this one's also a hidden feature, but you should kind of get the general knowledge, right? If there's an equation going on, what are you trying to do? You're trying to balance the book. So in this case, the balance sheet is correct. You are testing the accounting equation when you are doing the balance sheet. Okay, so that means know the difference between the 4 financial statements, right? And what they do. What do they provide for us? Okay. Number 5, okay, what is the difference between the accountant and the bookkeeper?
A.
Okay, so the accountant records, creates financial statements, and analyzes the business transactions, while the bookkeeper only records business transactions. Absolutely correct, right? The bookkeeper only has one job, and that one job is to just only record the business transactions. They cannot ask any questions except for how to do something, right? But they cannot ask questions in regards to why is this statement like this, okay? Because that's analyzing the information, right? They're strictly only there to record, okay? While the accountant will handle all of that stuff and do a little more, okay? All right, so chapter 2. So in this case, right, I have it set up like this, but what I'm going to do is that for this example, right, for the exam, I will give you a cash account, right? And I'll give you a description of each account. Your job is to determine the account type, the account category, and what kind of normal balance it would have. Okay? So that, and then how I will phrase it in a question is I will give you letter A, asset, current, debit. Letter B will be asset, other, credit. Okay? And your job is to find which one that fits all 3 of the answers. Okay? So in this case, I don't have it set up that way, but this is just a little easier to get through all the questions. So number 1, cash. What kind of account type would cash be? Remember, there's only 5 account types.
Is it an asset?
It is an asset, okay? I'm going to use abbreviations, okay? And it's an asset, but what kind of asset would it be?
It's a current.
It's current because it's already in its liquid form. It's already in cash. Okay? And what kind of normal balance would this have?
Debit.
Yes, it would normally carry a debit balance. Okay? What about accounts receivable, which is when customers owe you money?
It's an asset, current, and it's also debit.
Excellent, right? Because in this case, right, we just bill our customers and they should give us our cash back as soon as possible. Okay. What about inventory? What kind of...
If I remember right, it's an asset fixed, isn't it?
It's not a fixed asset.
Oh, okay. Then it's got to be other.
Okay, so it's not other either because other has one key feature. It's intangible. Now, inventory is 100% tangible.
Yeah. Okay. but it is an asset, right?
It is an asset, 100%. That's correct. You do own the inventory.
Isn't that incorrect because it value changes like a cash? Like it increases and decreases. It's the way I thought it.
Okay, yes, in aspect, yes. It does increase and decrease. Now, what's the purpose of us obtaining inventory? Why do we have inventory?
Because we're gonna sell those.
We're gonna sell it, and if you can turn around and sell it, right? You open up your shop and say, hey, I have a whole bunch of inventory. You wanna buy something? Go ahead and sell it. That means I can convert my inventory into cash instantly.
Gotcha. Okay,
Mm-hmm.
I wasn't thinking that. Sorry.
No worries. Good. That's why we come to the study guide to elaborate, right? So inventory, you own it until you sell it, right?
Right.
There you go.
But it is an immediate cash available.
Exactly, because I can have inventory for a whole week, and if I need cash right now, I can open up my shop and sell as much as I can for that whole entire day and be able to get the cash immediately.
And it's debit also.
Correct. Good. Okay. All right. What about equipment?
It's a fixed asset.
Correct. In this case, yes. The key component about a fixed asset is it's tangible, okay? But the thing about a fixed asset is it falls under that category, right? Is it a property, plant, or equipment? Equipment is like a machinery that helps you operate your business, right? When you purchase it, you own it. But can you tell me, can you sell it immediately? Is it something that you can get
No.
cash back for it? No, especially if you used it, right? Okay, so good. So in this case, it's a fixed asset. Now, what's its normal balance?
Well, it's an asset, so be a debit.
Good, right? You are more likely to increase your assets every time you purchase equipment. Yes. Okay. What about land?
It's also fixed asset.
Yes, it's part of property. And of course, if you ever go into real estate, it can take anywhere from 6 to even 2 years to go through escrow, right? Because escrow does more than just transfer ownership, right? You have to go through appraisals. You have to put it on market. Someone has to be a potential buyer. Then you have to go through credit checks and everything, right? And you have to go through equity checks too, right? Can you afford this piece of land? So in this case, escrow is what causes it to not be able to get converted into cash right away, okay, unless it's short-sailed, okay? All right, so what kind of normal balance would land have?
Debit.
Mm-hmm. Right? What about a prepaid account? So for example, prepaid rent. You paid rent in advance.
I thought it's asset because we own the money. It belongs to us.
Yes, it does.
And then I thought it would be other.
It is other because can you actually touch rent?
No.
No.
Although it's ours, somebody also has it.
Right, but in this case, we paid somebody in advance. As
Yeah.
in, we
Oh,
gave
okay.
them money to rent out this property for the next 2 months. So that
Yes.
means I own that rent for the next 2 months.
Yes.
Okay? And we can't physically touch rent, so. Okay? And what kind of normal balance would it have?
It also has a debit because it's asset.
Correct. Okay. What about an accounts payable where you owe vendors money?
The liability.
It's a liability because you owe money, right?
And it's current because it's due all the time, isn't it?
That's true, yes. Especially it's due within a year. Okay, so a lot of vendors, right, usually give you that 30, 60, 90-day policy. Some go for 6 months, but other than that, most likely it's a short term that you owe them for. It's a very short amount of time that you owe them for.
And it's a credit.
And it's a credit, good, right? Credits increase liabilities, or liabilities are increased by credits, okay? What about unearned revenue? It's where customers pay you in advance for services that have not been completed.
I thought it was income.
Okay, it is not income because you haven't done the job yet.
Ability because you owe something to someone for that money.
Correct, right? When a customer pays you in advance for service you haven't completed yet, you owe them service. Okay? So in this case, right, if someone gave me $20 to say clean the yard, but I don't want you to clean the yard until Friday, right? Then that means on Friday I owe them service. I have to complete it because they already paid me. They can come after me and say, "Hey, I gave you $20 and you didn't even do the job." So they can still come, they hold me, it's a liability because I owe them service. So in this case, yes, it is definitely a liability. Now, what kind of liability would this be?
It's calling because we need to pay it off sometime.
Okay, so in this case, we're not paying anybody.
Well, we needed to provide the service or the item to that person.
Correct, right? And typically
In a short time frame.
in a short time frame, right? You wouldn't be owing somebody service a year in advance unless you're like a wedding venue, right? That has to hold the place for at least a year in advance. But for most cases, you would more likely see somebody to owe you the service within either 30, 60, 90 days, right? Because again, it's like you paid me $20 to mow your lawn, right? I'm not going to mow it a year from now. I'm going to mow it either Friday, or if I can't make it that Friday, I will mow it the very following Monday, right? It's a service that's going to be owed, and usually typically it should be within a specific time period, and it's definitely not more than a year. Okay? And what kind of balance would this have?
Credit.
Mm-hmm. Good. All right. Next we have here is loans payable.
That's a liability.
Yes. Long term.
Generally long term. Yeah.
Yes, generally most loans, unless it's specified that it's a short-term loan, but most loans are usually starting minimum 3 months to as long as 36 years, right? Or I'm sorry, 3 years to 36 years, right?
Right.
So in this case, what kind of
It's
balance would this
credit.
have? It would have good, right? It would definitely have a credit balance. Okay. All right. What about owner's equity?
It's owner's equity.
Yeah, it's owner's equity. Good.
And it doesn't have any category.
Good.
And it's credit.
Good. Right? Owner's equity, which is your value of your company, right? Anything that affects it would be an original investment. Okay. And what about a owner's withdrawal?
Isn't that still in the category of owner's equity?
Correct.
That's what it comes from.
Mm-hmm.
With no category, but it would be a debit.
Correct, because in this case, owner's withdrawal takes away from your company. So therefore, you're decreasing the value of your company. So that will definitely be a debit balance. Okay. What about sales?
That's revenue.
That's revenue. Good. Revenues or income, whichever one that you know it by. Right? And what kind of category would this be?
I have a question.
Mhm.
Right, the sales is what is it? Sales. The category is sales.
Yes.
And then it's a credit.
Yes. What was your question?
And then my question was, I believe during the class you mentioned a couple of times that revenue and the income are used in the same meaning
Correct.
throughout the class. Okay.
Mhm.
So it's a matter of which word we use.
Mhm.
Okay. Thank you.
Mhm.
Or
Be-
which the test uses.
Oh, well, it doesn't matter, honestly. They're, like I said, they're interchangeable, but when we dive
Right.
into QuickBooks, right, they refer revenues as your income because you're earning income for your business. But we also know that
A lot of companies call it that.
a
too,
lot of,
so.
yeah, they do. But revenues and income, they're interchangeable. Um, but I can tell you this because income can also refer to your revenues minus your expenses, right? Because we call that net income. So that's why in my instances, it's like if you're using one terminology, you know, in this case, I'm teaching you both, whichever it can be referred to as, not one or the other. Because if you one day come across and they talk about revenues, you're gonna be like, what is revenues? Well, revenues is what you earn. It's your income. So in this case, I teach it kind of both ways. It doesn't matter which one you use. Just make sure that when you are in your proper work setting, just make sure you do know that revenues and income, they're the same thing. Okay? If they refer it as income, then refer it as income. If they choose revenues, then choose revenues. Just know that income can also mean a lot of other things as well. Okay? All right, good. So your sales is revenues and income. And because we are looking at a merchandising standpoint, your main core operating income is your sales. So whether you did sales or operating income, those are also universally the same as well. Okay, because in this case, because I'm doing merchandising, my main core of income is sales. But let's say you are a service company, right? Then your operating income would be service. Okay? So that's why I put operating income, because what if you provide both service and sales products? Then you would refer that as operating income more than you would for just plain sales. Okay? Just FYI right there, okay? What about cost of goods sold?
It's an expense
Mm-hmm.
and it's a cost of goods category.
Good. COGS
And
for short.
And it's a debit.
Good. Okay. Rent expense.
It's also expensive.
Mm-hmm.
I mean expense.
Mm-hmm.
And it's operating expenses.
Good.
And it's also a debit.
Good. Right? You need the rent expense in order to operate your business. So it's going to be an operating expense. Good. Last but not least, supplies expense.
I also it's expensive.
Mm-hmm.
It's operating expense.
Mm-hmm.
It's a debit.
Okay. So in this case, right, supplies expense, right? You're using your supplies to operate your business. So that's why it's considered an operating expense here. Okay. Good. So again, these may not be the only accounts you will see. These are just examples. Okay. So again, you have this. You also have the example that we did in chapter 2, which I posted the answers to in the section for the chapter 1 through 4. You also have the abilities to use all the exercises with all the answers there to help you on the exam as well. Okay. All right. All right, next question, number 9. Okay, what does left mean?
Debit.
Yep. What does right mean?
Credit.
Mm-hmm. All right. Question number 11. If your company has a total assets of $125,000, okay, and a total liabilities of $45,000, what is the total owner's equity?
80,000.
80,000. How did you get that answer?
You subtract the liabilities from the assets, and that gives you the equity.
Good. So here we just use the accounting equation assets equals liabilities plus equity. Okay. So in this case, if I have a total of $125,000 equaling to 45,000 plus E, right? All you have to do is take your 125,000 minus the 45,000 and you should get your equal of $80,000. Okay? So this is a perfect example of using the accounting equation. Okay? All right, next question, number 12 here. Which accounts types normally have a debit balance?
B.
C, assets and expenses. Yes, so again, you can definitely get this answer from using the accounting model, right? Which one points upwards for the debits? Right? Number 13, which of the following account types are temporary accounts?
Revenue and expenses.
B, revenues and expenses, right? You can also get that from the review sheet because I label it right on top that the revenues and expenses are your temporary accounts. Okay. All right, moving into chapter 3 now, okay? When journalizing a transaction, which statement is true?
Debits have to equal credits.
Yep, your debits must equal credits. Cannot live without this, okay? This is the key fundamental rule here, right? If you have an action, you must have an equal and opposite reaction. So your debits must equal your credits. Okay? Question 15, okay? What are the methods used for correcting errors in the journal?
A and B.
A and B, so letter D. Let's see, A is the error cancellation method. Yes, that's true. B is the reverse and reentry method, which is true. I never taught you a cross it out method. So in this case, A and B only. Good.
That just sounds funny.
Yeah, right? And it sounds
Cross
like
it
it.
out and move on.
Yes, right. Cross it out and move on. Good. Number 16. Okay. You made a purchase of office supplies for $56 cash, okay? But you recorded it in your books for your office supplies for $65, okay? Correct the error in the entry using both methods. So the first one I want you to do is the reverse and reentry, okay? So how do I reverse this transaction in order to correct this transaction?
You put the 65 back into cash.
Okay, good. Right, we're gonna refund the office supplies for $65.
And you oh crap. And out of supplies, you you take the 65 out of that too. And then you go in and you do office supplies for the correct amount.
Good. Office supplies and
And you
cash.
get cash for the correct amount.
Good. Right, because right now I recorded it as 65, but right now it's actually 56. Okay, good. Okay. I'm not gonna test you, or in this case, you won't be. I won't be looking at your answers when you answer this, right? I just need you to be able to determine this, right? I'm going to record my cash as XYZ and my office supplies as XYZ, right? That's what I'm looking for. Okay, so A could be debit cash for 65 and credit office supplies for 65. Okay, B could be debit office supplies for 65 and credit cash for 65. Okay, make sure you're able to answer those questions exactly like that. Okay, and then error cancellation. Yes, did you have a question? Okay. What about error cancellation? How will I be able to do the error cancellation if I recorded my books, my office supplies at 65, but in reality it's 56?
When we include the cash by 9 by putting in debit,
Okay.
because we took cash too much from the, so we are putting back the cash.
Good, right? In this case, we originally journalized that we spent too much money. Instead, we need to put back that money. So in this case, I am going to be debiting my cash because I should actually be getting cash back. And I'm going to be having less office supplies. Now, what do I put in my debits and credits?
$9, because that's the difference.
Good. So in this case, we recognize what the difference is. The difference is $9, right? In this case, I have to ask myself the question, right? Which account do I have more or which account am I under? So in this case, I have too much cash. That means I need to put it back. And I have too much office supplies, so I need to put it back. Okay. All right, number 17. Okay. What is the difference between the general journal and the general ledger?
It's C.
Okay.
The general ledger is a list of all the company's balances.
Okay. Okay, so let's go through the answers. A says general journal has a list of all the transactions, okay, with their balances. No, that's not true. That's the ledger, right? And the ledger only lists the daily transactions. No, that's not true. However, the general journal is a list of all the transactions with their account balances. So in this case, letter C is correct. Okay. All right. Moving into chapter 4 territory here. Question number 18. Which of the following steps belongs to the accounting cycle? Okay, so here you have a list out here. Which one belongs to the accounting cycle?
Wouldn't it be D? Because all of them are in there.
All of them are indeed there, right? You have both 1, 2, 3, 4, 5, 6, and 7, 8, 9, and 10. Good. So in this case, all of them are there. Now I can ask you various different questions. I can ask you to put it in order. I can ask you which one does not belong, just like this one. I can give you a list of them, and then one of them isn't going to be part of it. Okay. Question number 19. Okay. Which of the following is not a characteristic of financial statements?
Reasonable?
Yes, right? How can financial statements be reasonable, right? It has to be reliable because, of course, the information that you're providing, right? People have to trust it. It has to be reliable because we have our source documents to back up and have proof that a transaction has existed. It has to be relevant, right? In the same time period, right? I'm not going to put a transaction that happened 10 years ago because the value of the dollar 10 years ago is obviously different, right? But in this case, when we talk about relevancy, we're talking about relevant with the time, right? Relevant with the rules. Are they up to date? Okay? And even consistency is using one kind of method and sticking it through all the way out through the entire accounting period. Being consistent, because that's going to produce the most accurate answers. So in this case, you're not going to be producing the financial statements to be reasonable. Okay? You can justify it saying, look, I'm reasoning with you, that I'm making a profit and this is the reasons why, but at the end of the day, that's not a component of why you need to produce the financial statements. Okay? Number 20. Okay, so now we're moving into the rules of GAAP. Okay? Under the rules of GAAP, which rule states that personal assets should be separate from business assets? A, the business and economic entity, right? Where you need to separate your personal from your business. Good. Okay. So again, I can ask you questions that could include, for example, this materiality, right? That's a convention. I can ask you that, but you have to remember, right? I'm not going to test you on it. So that could be a way for you to say, okay, D is eliminated for sure. Okay. Number 21. Okay. Under the rules of GAAP, which rule states that when recording a transaction, it should be recorded in terms of money or value?
C.
In this case, this one's a straightforward one because we dealt with terms of money or value. Monetary assumption would be it. Okay? Now, if you remember, I did mention this. I'm not going to test you on the different monetary assumptions, right? Because there's monetary measurement, monetary unit. I'm not going to test you on that as long as you know it belongs to monetary assumption is all I care about. Okay? Number 22, under the rules of GAAP, which rule states that when making a purchase of an asset, okay, they are recorded at original selling price. Okay, the value does not change over time.
Historical cost.
Historical cost, yes. Good. Okay. Question number 23. Cash basis is when?
A and B.
A and B. So A says revenues are recorded when cash is received. And then B says expenses are recorded when cash is readily available to spend. Yes, that is cash basis. Okay. Only record when cash is present. Okay. 24. Accrual basis is when?
When they're incurred.
Yes, when expenses are recorded when incurred, right? So in this case, answer C is correct. Okay. And like I said, this study guide can be done in one day, but I need content for tomorrow. So in this case, I don't want to let you guys go tomorrow for whatever reasons that you